Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, January 28th, 2022, and joining Derek to pose some questions on the financial market themes for the week ahead is Michael Owen, MUFG's Head of Global Client Desk for EMEA in London. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Welcome, Derek.
Thank you, Michael. Good to catch up.
And wishing everyone a happy new year as well. Derek, it's been another week of some big market moves. Despite many believing we're already aggressively priced for the Fed prior to the FOMC this week, there was still another big market reaction. What were the key takeaways from an FX perspective from the FOMC meeting this week?
Yes, indeed, Michael. We've had another week of big moves, and when I was on this podcast a week ago, I suggested the significant pricing of rate hike expectations meant the kind of hurdle for another big move was that bit higher. But despite that, Fed Chair Powell, along with some aspects of the statement, certainly indicated a kind of another move up in the level of hawkishness, and that's resulted in this kind of big further move in rates and indeed a move for the dollar. I think from an FX perspective, and I've said this before to clients, the key thing, given how much is now priced into the markets for 2022, is more about the views and the interpretations of the markets over the peak in Fed funds, or what's known as the terminal rate for the Fed funds. And since November through basically to this week, the markets just wouldn't go above 2%. So what investors were saying basically is that, you can go this aggressively in 2022, but it means the overall peak in Fed funds will be certainly lower than before. That has changed this week, and I think that's one of the key reasons for this kind of broad-based further strengthening of the US dollar. And that's down to one key takeaway, I think, from the FOMC. And that is the reluctance of Fed Chair Powell to indicate to the markets any kind of guidance in terms of the speed and the extent of the cycle that lies ahead. And, he said that the Fed needed to act nimbly. It needed to be humble, and essentially was open to all scenarios. Admittedly, both on the upside and potentially on the downside. But of course, where inflation is today, the focus is all on the potential upside in terms of the extent of the speed of the tightening cycle. And that's resulted in the beginning of a shift in thinking, perhaps in terms of that terminal Fed funds rate. We've broken 2%. In terms of measuring that out to December 2024, we've now gone to 2.06% for around the peak for Fed funds. And I think over the short term, there's the potential of that to go further. I think also the release of a statement in terms of balance sheet guidance has kind of reinforced the prospect of the Fed moving quite quickly in terms of quantitative tightening, the shrinking of the balance sheet. And I think that those two key takeaways, I think, have really encouraged the further move in rates at the short end in particular, because we've had a flattening of the curve, which historically is also linked to US dollar strength. So you stick with it. There's nothing more really to say. This kind of move up in the kind of peak Fed funds rate, the hawkishness. It all sits with this momentum carrying on, and I can't really see that changing very much. There are some caveats for later on, perhaps. We had the ECI wage data from the US today. Still quite robust, but we have seen a slowdown in the quarter-on-quarter rate. for wages and salaries from 1.5% to 1.1%. And that's a pleasant surprise. It came in weaker than expected. Let's see what the average earnings figures bring next week in the non-farm payrolls. Certainly, though, the ECI would be suggesting possibly we're there or thereabouts in terms of the peak upside momentum in wages. And that would certainly be a relief for the Fed. But that's for later in the year when perhaps we think they can start to pull back from the extent of what they're communicating in terms of rate hikes. But for the moment, everything's to the upside in terms of inflation risks. And in that sense, the rates market is going to remain well supported. And that kind of broad-based move for the dollar that we're seeing at the moment could certainly have further to run.
I guess this week it might change given we've got a host of other central banks meetings. How do you see this week playing out and what might be the G10 FX repercussions?
Yeah, we do. And again, reminding listeners of the kind of broad-based MUFG FX view. We've highlighted quite a lot the fact that this monetary tightening cycle will be more synchronized, will be more of a coordinated fashion. The Fed are in focus at the moment, but, back in the 2013, 2016 cycle, the Fed the 15 to 2018 cycle, although the communications for that began in 2013. But, the Fed were completely on their own in that cycle. And that's what the dollar strengthened so significantly from very undervalued levels. This time, there will be more coordination. And I think that will be on show next week to a degree. The RBA, for example, have been quite dovish in terms of their guidance. They're meeting on Tuesday. We have the annual median inflation rate, the core rate that the RBA looks at. That's moved above the midpoint of the 2 to 3% target range. And that's the first time since 2014, I think. So I think, quantitative easing will obviously end. That's a pretty much a done deal. But they could also open up the prospects of rate hikes towards the end of this year. And I think that certainly reinforces the idea that the RBA will be on the move this year. The Bank of England are going to hike, we think, 25 basis points. That's fully priced into the market. In terms of guidance going forward, certainly, the inflation picture is definitely worse than when they last released the monetary policy report in November, and worse from when they raised 10 basis points in December. I would imagine the monetary policy report, taking account of the more aggressive tightening profile priced into the market, will still mean that in 3 years' time, the inflation projection by the Bank of England will be back below the 2% level. So a harder fall in inflation will be in the projections. That's our view. And that should curtail hawkish interpretations. And I think it might contain the reaction in the markets. But nonetheless, there'll be tightening. While the guidance might be a little bit more reserved than what we've been getting from the Fed, it's clear that the Bank of England will be hiking rates. Where I think there will be divergence next week in terms of central banks relative to the Fed will be the ECB. And they meet on the same day as the Bank of England on Thursday. And, I think by and large, the key senior people on the ECB Council are going to repeat their view, and that is that the inflation spike in Europe is more of an energy story than it is elsewhere. And 50% of the total increase is purely energy. And that, from an ECB perspective, means they can be far more cautious in terms of signaling a change in policy and a rate hike. About 20 basis points is priced in the OAS market by the end of this year. I'm sure Christine Lagarde is going to push back on that, either explicitly or implicitly. And I think that's just going to reinforce the divergence and reinforce the current momentum, which is clearly euro-dollar to the downside. And we're still quite confident in our target of reaching 110 through the first quarter.
Thank you, Derek. And just on trade ideas, you've obviously had an oil focus to your trade ideas this year with a big movement in oil in January. Have you made any changes to your trade ideas in the past week?
Yes, the riskier trade view that we had on was long the Norwegian krone versus the Russian ruble. Obviously, Russian ruble extremely high beta at the moment, given the geopolitical situation in Ukraine. And essentially that's moved against us. There's I think a little bit of hope has come into the markets towards the end of this week over the negotiations continuing with Russia. And that's resulted in some outperformance for the ruble. So we've closed that and we've gone with a more traditional risk-off emerging market trade. And that's long the US dollar versus the South African rand. And, certainly when it comes to rate differentials, your kind of most reliable play, perhaps, in the EM space would be short the South African rand. So we've put that on. And in the G10 space, we've kept our short euro, as I was just talking about, and long the Canadian dollar. And even though the Bank of Canada didn't raise rates this week, which has resulted in some Canadian dollar weakness, we still think the guidance from the Bank of Canada is consistent with renewed Canadian dollar strength. Maybe not imminently, but we don't see much to the downside either. And of course, with crude oil prices remaining elevated close to cyclical highs, we think the downside for Canadian dollar is quite limited, and at some point relatively soon, we'll see the Canadian dollar stabilise and come back a bit.
Thanks very much, Derek, and wishing everyone a good week ahead.
Thank you, Michael, and you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research Team.